I just wanted to quickly introduce Peter Altman. Peter is going to be handling the introductions this afternoon. He's our other program chair for the day. Peter's a partner at Aiken. He's based in the LA office, and he serves as a leader in that firm's investment funds practice, and as well as its digital assets, crypto, and blockchain practice. And previously, Peter served in the SEC's Division of Enforcement and as a member of the division's Market Abuse Unit. Peter, thanks so much for taking on the intros. Appreciate it.
All right. Thank you, Bruce. And thank you to Bruce for seeing the light and finally bringing this great conference to Los Angeles. It's great to have it here. As much as I love going to East Palo Alto or San Francisco. So, very happy to be here and to get to introduce the afternoon panels. And so our next panel, Minding Your K's and Q's, the latest issues and developments in financial reporting fraud. Our moderator is Jennifer Lee, partner at Jenner & Block, former assistant director at the SEC, who you all got to know this morning. Great job this morning, Jennifer. Our SEC panelist in the seat to Jennifer's left is Doug Miller, the regional trial counsel at the LA regional office. Doug has a distinguished career in public service, being in AUSA here in CDCal, and then also a captain in the Air Force JAG Corps. Welcome, Doug. We're rounding things out with 3 former members of the SEC's Division of Enforcement, very experienced practitioners in the space. Down at the end, Craig Martin, partner at MoFo and former member of the Division of Enforcement in San Francisco. Welcome, Craig. Juan Migone, or as I said to Juan beforehand, in Brooklyn, it might be Migone.
That's right, I like Migone.
We can go with that. All right. A partner at StoneTurn, and prior to joining StoneTurn, Juan was an accountant within the Division of Enforcement. And then Jose Sanchez. Jose, welcome back to private practice. Jose is a partner at Foley. He joined Foley after spending time in the Office of General Counsel at Deloitte, where he served as lead counsel and senior managing director for the Americas. He was also former senior trial counsel in the SEC's LA regional office. Jennifer, turn it over to you.
Thank you. So we know it's post-lunch. You probably are really tired, but we're going to try to spice things up by talking about all things financial reporting, which is, right? Well, it's funny, but it is the area that has the most uncertainty right now, right? Like if you read the Wall Street Journal, every day there's some horrible headline about tariffs, maybe they're on, maybe they're off, sanctions, inflation, interest rates, just everything that a public company would be facing as their nightmare. And yet they still have to continue business as usual, filing their earnings, whether it's on a quarterly or annual basis. And so these are the things that we're going to talk about today. But before we get to that, let's set the stage, Doug, by talking about just how has the SEC thought about financial reporting cases in 2024 up through 2025.
Okay, thanks for that. Before I get started, this is my first time doing this panel, and the panelists have been fantastic. They told me, we're going to let you go first. We're going to talk about cases you may not have read about, but we've studied closely. And we're going to have you go on for about 10 minutes. So prepare for that. I'm going to do my best. Having dug into these cases that I'm going to talk about, they are very interesting. And I think I've tried to sort of condense it down, but it does go for about 10 minutes. And I'll try to bring, as I go through them, highlight what I found interesting. The panelists may disagree, they may have other thoughts, and we'll try to move through it. Before I do, I should say that my remarks today are in my official capacity as supervisory trial counsel for the Los Angeles Regional Office. These are my thoughts. They don't necessarily reflect the views of the commission, the commissioners, or other members of the staff. Also, I'm going to be talking about some cases that are ongoing, and so just bear in mind that these are complaints, and what I'm talking about are just allegations, okay? And I haven't worked on any of them, so they really are just words on a page for me. But I'll try to explain what I saw when I looked at them. So the first one I thought I would bring out for this audience is what I call the Kubient matter. This is a case that was filed down in the Southern District of New York. It was filed in September of 2024. This is a case where basically the core charges are lying to auditors and false financial statements. This is a case that I thought was interesting, and the other panelists I think will agree, because it's one in which the charges were directed not only at the CEO and the CFO, but sort of a new face in a charging document, the chairperson of the audit committee. And so I thought I'd talk about this case a little bit today. The case for me highlights the important role that the audit committee plays in corporate governance. You're going to see as I go through the facts that at least on this case led to the chairperson of the audit committee being charged, and these are fraud charges. So pretty serious stuff, but I think as I go through it, we'll at least explain what's been alleged, and you guys can hear what led to those charging decisions. So Kubient, just in case you don't know, or probably don't, this is a company that provides digital advertising services to its customers. One of the ways they do that is through an AI technology. So if you've dealt with AI, this is a very data-driven technology, and what the company president did, or CEO did, was they were about to go through an initial public offering, and part of that was they needed to explain some of the revenue that they had generated through their customers. Two of the reports that were created to explain how they got revenue through two of their customers basically made the representation that the services that were provided to these customers was based on data that the company had provided for their AI technology. So they provide the report, the CEO provides it, the CFO asks him for it so he can provide it to the outside auditors because they're about to go through an IPO. And when the CFO gets it from the CEO, he notices some discrepancies. Again, these are allegations, okay? I don't know if you've worked on these cases. And so the discrepancies that the CFO notices are that the invoices that describe the data that was relied upon in in providing these services to their customer is different than the data in the report. I think the numbers didn't match up. You would expect the amount of data that was considered to be the same. So the CEO provides that to the CFO. CFO sees this discrepancy but doesn't do anything about it. So I view that sort of as a red flag as I was reading the complaint. The complaint makes it very clear that they expected, in the way the complaint is written, that the CFO should have done more once he identified that discrepancy. What the CFO did, according to the complaint, is just to ask the CEO, hey, the numbers don't match. Do you want me to make them match? And the CEO said yes. And that got forwarded out to the outside auditors. And then the outside auditors now have the reports that are not based on the information they contend to be based on. So time goes on, and then the reports, some senior official in the company goes to the chairperson of the audit committee and says, hey, these reports are not based on the customer data, they're based on samples. And the chairperson for the audit committee, according to the allegations, didn't take that information and provide it to the outside auditor. What she did was provide that to the CFO, and neither the CFO nor the chairman of the audit committee took that to the outside auditor. That was really the core, why this was important. If the data had been considered, it would have made the $1.3 million in revenue that was taken basically permissible, but if they hadn't considered the data, then the $1.3 million in revenue should not have been included, which would have changed their financial statements. This was very important because they were going through an IPO, and sort of the use case for the technology was that certain customers had used it. So I think the allegation suggests that this was very material. What these facts led to, also the chairperson of the audit committee convened a board meeting, but they did not invite the outside auditor to attend this meeting. This was the first time that this ever happened. Then when they prepared, I guess at the committee meeting, they decided not to prepare any minutes of what happened during the meeting. And this was the meeting at which they discussed this report, because what happened was when the senior level person reported it to the audit committee chairperson, they had a board meeting, but they didn't invite the outside auditor, and they didn't take any minutes. The CFO allegedly got involved in this because the next board meeting, the CFO made the minutes look like the last boarding was one, the last board meeting hadn't taken place. These are all allegations. So under those facts, that resulted in the chairperson of the audit committee being charged, along with the CEO and the CFO. These were anti-fraud violations under 17A and 10B. There was also books and records violations and internal control violations. So, sort of the whole boat, and included in those charges was the audit chairperson. So, the next case was Kiromic. This is Kiromic. This is a case that was filed down in the Southern District of Texas. Case that was filed in December of 2024, so right towards the end of the year. But this was just in a disclosure failures case. So this is a case that was filed as what we call a settled matter. The company and the CFO were charged by way of a cease and desist order, and the CEO was charged in district court. Again, all of it settled. I bring this case out for two reasons. One, it sort of touches on the important role that the gatekeepers play. Again, that you'll hear about how the CFO was charged in this case. But also, this was touched on, I believe, by Gary earlier, or at least his panel. It talks about cooperation and remediation. And this was one of the cases where the company did not end up being assessed a penalty. And so you'll see as I go through some of the things that may have led to that decision. Okay, so what is this case about? So this is a case, Kiromic is a company that develops drugs to fight cancer. They were about to go through an IPO, sort of like the last case, and the CEO found out that the clinical trial in which they hoped to test out this new drug was going to be on what they call it, was being placed on clinical hold. So that's when the FDA basically says you can't do your clinical trial until you fix these things. So the CEO knows that. This is a case where I think someone in our preparation said he may have, if he was a doctor or something. But anyway, he now knows that this is on clinical, there's a clinical hold, they're about to go through an IPO, and the question becomes, what does he do about it? According to the complaint, he acknowledged that this was something that needed to be disclosed promptly. But when he convened a board meeting, he did not use the precise term clinical hold. Now, there was allegations in the complaint that made it clear that English was not his first language. He was someone that I guess had been born in Italy. And so I think the reason this is being included in the complaint, but again, this is just my thoughts, is they're trying to show the evolution of when people learn things, okay? So at least at this stage in the complaint, it sounds like only the CEO knew about it. But eventually, as you read on, the CFO definitely figures out that this is on clinical hold. They continue to raise capital, and so far the CEO is the only one that knows. Obviously, he gets charged. But then there comes a time when the FDA letter arrives, and it says and that's not just a phone call like the CEO got, now it's a letter. The letter says this is now on clinical hold. The CFO knows about it, and as you might guess, the CFO realized they needed to do something. But what you read in the complaint is that the CFO, although he urged prompt disclosure, the company issued a press release that never used the term clinical hold. What's more, when the 10Q came, the CFO signed and certified that even though it failed to disclose the clinical hold on the trials. So this resulted in the CFO being charged. I think he was assessed a $20,000 penalty. Another reason I brought this out, as I mentioned, is this is a case where the C&D explains what the company did when all of this came to light. So several of the things that were highlighted was after conducting an internal investigation, the board adopted several remedial measures and improved disclosure controls. They appointed a CEO who received training on disclosures and controls. That's one of the things that was highlighted. They established a disclosure committee made up of management. They appointed 2 independent board members. They fired the CEO for cause. They issued an 8K acknowledging the failure to disclose. They self-reported to the CEO, or to the SEC, and they cooperated with the commission in providing declarations of foreign-based witnesses. So pretty clear and explicit things were laid out in the OIP explaining what the company did. And again, I can't say that resulted, but I note in the OIP that there was no penalty that was assessed against the company for that. Last case I'm going to talk about, Securities International. This is a case that we filed in, not the Los Angeles office, but the SEC filed in the District of Massachusetts. This case was filed back in September of 2024. This involved lying to auditors and false financial statements. I wanted to talk about this case today and see if it elicited any comments from my other panelists, because to me, it's one that sort of explains some of the facts that could lead to CFOs and chief financial officers not getting charged, and sort of isolating the charging decision down to the wrongdoers specifically, or at least the people who initiated the wrongdoing. So this is a case where the company also took remedial efforts and was not charged with fraud charges, but I'll get to that. So this is a company that manufactures technology, Securities, for the defense and aerospace industries. According to the complaint, it had a business unit overseas. The business unit was run, or at least had a financial director who had responsibility for sending back the financials to the company in the United States so that they can be entered into their consolidated financials. But they had sort of totally delegated that responsibility to this person. The division he was over, I think it was pipeline engineering, wasn't doing too well, it sounds like. And so he had the responsibility of not only sending these financial information back, but he was the one that also controlled all the bank accounts that would disclose whether or not the money he was contending was in there was actually there. And he was the one that was responsible for making sure that it got sent back to the company with only him looking at it. What turns out what he was doing was inflating the financial condition of that division, sometimes by tens of millions, or $10 million, excuse me. So when I think the complaint said that there was $2,000 in the account, he said there was $10 million in the account. So I think those allegations show the materiality of it. But what the complaint also lays out is there were clear efforts by him to circulate internal controls. He was fabricating bank documents. He was sending those fabricated bank documents to the chief accounting officer of the company, as well as to the outside auditors. And really the way that this was detected was the outside auditors saw all the round numbers in the numbers he was reporting, and they sort of got suspicious, and so they did a little digging. Interesting, because again, only the fellow who was off in the UK submitting the numbers was charged. The company was charged, but they were not charged with fraud charges, and they didn't get a penalty in this case either. Another interesting thing to note is the person who was charged, he was charged by way of a complaint, and in that complaint, they are seeking, and I think this was the settled case, so they got it, a permanent bar from acting in accounting or financial reporting capacity at a public company. So not in a 102E, but this in the charging of the complaint itself. So what did the company do to sort of potentially contribute to them not being hit with fraud charges and no penalty? What the OIP laid out was prompt reporting of the accounting errors to the SEC, substantially cooperating with the SEC by providing detailed information during the investigation, summarizing witness interviews of witnesses located outside the United States, making witnesses available for interview, taking prompt and remedial action, like terminating the finance director, strengthening internal controls, hiring accountants with financial reporting experience, and canceling the wrongdoer's bonus that he was supposed to get. So with that, I want to thank you for letting me open things up. And
no, that was great. Thank you, Doug.
See if anybody had any reaction to that.
I do have a reaction. So I think the cases that you highlighted are so interesting because for me, they illustrate the Gensler-led SEC's focus on internal controls, whether that's internal accounting controls, disclosure controls and procedures, just what are a public company's processes in place to prevent misconduct. And I think many of us in this room would say, well, a lot of what Gary Gensler authorized, et cetera, had to do with controls cases where there actually wasn't misconduct at the end of the day, but the ones that you've highlighted, there was misconduct. So I wonder, for my panelists, do you agree? What do you see as being the message from the prior administration?
Well, I agree with that, right? In terms of the cases that you highlighted have intentional conduct. And so that's why I think in the new administration, you would see these cases make their way through. But I think there's other cases that were brought where there were focused on non-substantive violations, which focused on the compliance program and the lack of disclosure controls, accounting controls. And I think those are the ones that, while they may be investigated, ultimately I don't think charges will be brought in today's environment, at least especially if you have the kind of prompt response from audit committees and the CFOs investigating and then taking remedial action. I still think they'll be investigated, but the question is how long will they last, and then ultimately who's charged. And like these cases, I think we'll see the individuals being charged. Whether the company gets charged, I would expect less so, and definitely no fines if they do the right thing.
Craig, what's your take?
So I would like to just highlight the Kubian case, because that one worries me, and I hope that it turns out to be just a one-off and not the beginning of a trend. In particular, the fact, as Doug said, there was a new face on among the people being charged, and that was the chair of an audit committee. And we frequently are asked by our independent director clients, audit committee members, audit committee chairs, what's my exposure? We're often speaking with them in the wake of something going wrong at a company. What's my exposure? How is the SEC going to look at me? And up until recently, the answer to that question has been, don't worry. The SEC has brought cases against, for example, members of audit committees, independent directors, in cases where there has been affirmative participation by the independent director in the alleged wrongdoing. And I think what's interesting and different about Kubian is that the audit committee chair is not alleged to have affirmatively participated, but rather received information calling into question an aspect of the business that had an impact on the financial reporting, and didn't do the right thing in the view of the commission with that information. Knowing that audit committee chairs are often they're independent. They've got they've got a lot of responsibilities. They rely on management to do the things that they ask them to do and trust that they're going to be done. And that their communications with auditors are sometimes imperfect, and sometimes memories are imperfect in terms of communications with auditors. We've all looked at rep letters and understand that they're not written in plain English, that the terms are internally defined in those letters in ways that a non-lawyer may not necessarily appreciate. And so the risk profile of an audit committee chair is high. If the SEC is going to bring these cases, and I personally wish that in cases like this, that the commission would exercise prosecutorial discretion and not bring them against individual audit committee members. Because there's a cost. There's obviously a benefit when the commission brings a case like this to the commission's program. There's a warning that goes out to audit committee chairs. You better be careful when you get information. You better make sure it's properly investigated. You better make sure that you explicitly share that information with the auditors and that communication is properly memorialized. But there's a loss too when qualified people are reluctant to serve on audit committees because they fear that the SEC is going to come after them if something goes wrong. And I'm not in any way speaking to the merits of this case, but I am I do see this as something that I hope is taken into account in the current administration as they're thinking about these types of matters.
You know, I see that perspective, having been in-house at an accounting firm and having shadowed many matters, live audits where issues like this arise. I mean, what you expect is exactly what this audit committee chair didn't do, right? Which was to ask questions and to at least investigate. And I think there was another important fact in the case, which was there had been a senior level complaint as well. And part of the representations that are made to the auditors included whether there had been any complaints around revenue recognition or other type of issues. And so those are pretty important inquiries that outside auditors make and rely on audit committees, their chairs, and senior members of management. So I think it's right to question whether so the circumstances under which audit committees should be put to the task. But at the very least, I think what both a Gensler administration would expect, as well as a current administration, especially having seen the DOJ announcements earlier this week, is that you have to act. You have to ask questions, and you have to take appropriate, timely actions. Whether that all turns out to be accurate and you do everything perfectly is very different than not to do anything at all. So
Jose, let's talk about auditors for a second. There's been, can you talk about the landscape with respect to how the SEC has viewed them, what you see going forward? And I think there's also a recent Supreme Court petition regarding just what an auditor's role should look like.
Well, so gatekeepers have always been a target. And I think of gatekeepers in two ways, right? The internal gatekeepers and the external gatekeepers, right? The internal gatekeepers are the senior members of management, CFO, audit committees and chairs, and then on the other hand, the outside auditors. And I think these cases demonstrate this, as well as the ones where there are no charges, is so long as there's no intentional conduct or reckless conduct, then everything's okay. And so I think those are the kinds of plus factors that you look to when you're looking to charge a gatekeeper, whether internal or external, is at what point that their conduct, was there affirmative conduct, intentional conduct, not just negligent conduct, although under, I think, the prior administration, that was fair game. And so looking to the future, I think of that. I think the other consideration for these cases is materiality. And so the case that Jennifer's talking about is a case that's a petition before the Supreme Court. It's a case that came out of the Second Circuit involving accounting, an accounting firm, securities litigation, where there were bad facts in terms of there was restatements. The outside auditors actually issued their audit opinion before completing all of their audit procedures that were required for releasing the opinion. The SEC brought a case against the individual auditors with timeouts and other sanctions. But the question was whether in the private securities case, the fact that the opinion was issued before all of the requirements had been satisfied, whether the auditor's opinion stating that the opinion had been issued in compliance with GAS, with generally audit standards, whether that was sufficient to state a misstatement and then proceed. The Second Circuit initially held that that was not enough, that there needed to be a nexus between the actual statement and that financial information was in some way materially incorrect. What occurred was that after the auditors, the firm was made aware, probably senior members at the firm, that the opinion had been issued without completing certain procedures, they took remedial action, they completed the procedures, and there was no impact to the audit opinion. And so the Second Circuit said that didn't matter, that it was per se material, that the procedures had not been completed before releasing the audit opinion, and therefore that was sufficient to allow the case to move forward. The Second Circuit en banc took the issue up and determined that, I'm sorry, it's reversed. The underlying 3-judge panel held that it was not material en banc, held that it was material because it was a per se rule. And so the case has been appealed to the Supreme Court, filed this May, so you should keep an eye out for that. I mean, just materiality matters. And so the fact that, yes, strictly the certain procedures had not been completed before the opinion was issued, the fact of the matter is once they were completed and they were properly documented in the work papers, there had been no issue with the financial statements. The opinion was still sufficiently supported. And so under those circumstances, that should not be a basis for a private securities case. I also think it shouldn't be a basis for an SEC case if that was the fact pattern. But that's a current issue before the Supreme Court, which will have ramifications because otherwise any comment in a PCAOB inspection report, most of those are written that there wasn't enough procedures performed, the audit, there was a failed audit, but that would be the basis for a securities claim. And we know that many of those matters ultimately get remediated and they don't present any issues with the audit opinion or with any restatement. So that's why that's important to watch.
Yes,
but-
Doug.
Oh, go ahead. I was just curious. I saw the SEC had filed an amicus brief. Do you know the position they took?
Well, so this was also an interesting point because the position they took en banc was to support that was material. And so it'll be interesting to see what is the position vis-a-vis the petition, if the petition is granted or to advocate whether or not that should be taken. Given the current administration's position around materiality and objecting to per se rules, my guess would be that they would not support the decision before the Supreme Court to uphold the decision because it should be a factual question, right? Whether there was an impact ultimately to the financial information that the market received.
Juan, do you have a take on materiality? Just, I think in the previous administration, there was less consideration given to whether something was quantitatively material, that there was more consideration of qualitative factors. So even there was no stock price or impact on existing shareholders, it just almost seemed like if there was a problem, then the SEC was more likely to bring a case. What do you think about that? Where do you think things are going to go moving forward?
Well, two things. I actually want to talk
Oh,
about
sorry,
that
yes,
matter
go.
real quick. I mean, at the end of the day, it depends on which audit procedure wasn't done and the level of what wasn't done. Like if you just didn't look at revenue, for example, versus you forgot to document something, I think that would matter. But again, is it a situation where you got lucky and nothing happened, or is it a situation where, something could have happened? So that's why the rule's there. So it's going to be interesting to see how it comes out, but you got to consider what audit procedures were missed. And I think it's going to have a significant impact on the commission's approach towards auditors going forward, right? Depending on how that comes out, because there are circumstances where if you don't complete an audit and substantial procedures, how can you say the financial statements are consistent with gas? So, I mean, it's going to be interesting how it comes out.
And it also depends whether the PCAOB is still in existence, but we'll see.
True. And whether it's folded into the SEC. So, I mean, materiality, it's going to be interesting to see how this commission views materiality. I hesitate to speculate where it's going to go. But, I mean...
This is recorded.
I know, yes. At the end of the day, I mean, you got to look at qualitative materiality. It's very important. I think there's been speeches over the years by several chief accountants that talk about it's not just the number, it's the impact. Even a small number can be material, large number could be immaterial. I think what is going to be the impact to the investor, to the investment decision. I don't think there's going to be a significant change to the definition of materiality or how the SEC interprets it. But I think there's going to be a little bit more of a focus on the qualitative aspect of it, just from having been there through various administrations, Republican, Democrat. That's one thing that's been consistent, but the qualitative aspect has varied a little bit depending on administration.
Now, Doug, some of the cases that you mentioned, were litigated, do you have a sense of just going forward, are there particular factors, and I was thinking of materiality, things that might shift in terms of how the SEC is going to be thinking about what cases to authorize for litigation?
Yeah, so I mean, let's see. I won't presume to know how the chairperson might try to shift things on the margins about how he looks at cases and how they might be brought. I think in the end, what you can expect is that the chairperson is going to be focused on its core mission, which is protecting investors. I know that the chairperson has basically made comments to that effect. So I expect that protecting investors will still be the core of our mission. I expect that the charging decisions will reflect that. On the sort of edges, what we might look at from a litigation perspective, I don't think you can really know. Each case is different. Some of the things that we've sort of always considered, like, for example, penalty, I think we're still going to use. In 2006, there was a number of factors to decide, are we going to try to bring a penalty against a corporation? I think we're still going to be looking at those same factors. So I don't think at least I don't know of any major shift. But at least the focus from the chairperson, I believe, will still be, are we protecting investors? It's still early. If there's something else that he's considering, I'm sure we'll know about it. But from what I can gather at this point, that still seems to be sort of job one.
Gary said he's been in 3 weeks, 3 days. You don't know
Yeah,
that.
I don't have a stopwatch, but it's not a long time.
Well, so the other thing you have, I think you've got some tea leaves, right? Because you can look at those disclosure cases that were brought and the dissents, right? And the earlier panel talked about them, right? The cybersecurity cases. There was also the Keurig case where I think there was a belief that the failed disclosures or the incomplete disclosures were not material, and I think that will be different because there'll be more question. I think focus on that question is is detailed disclosure better, and usually it isn't, and I think there is that belief with the current Commissioner Ueda and Pierce and with Atkins that's not necessarily the case. So there'll be more push on that if the staff is trying to make out a disclosure case where there's no wrongful conduct, no intentional conduct, no real substantive violations.
Overall, Craig, I want to get you back into this. Do you think we're moving into a more pro-business environment with the new SEC?
I think if you ask any executive whose company is under investigation by the SEC whether the SEC is pro-business, you're going to get a fairly universal negative reaction. And so I think that over time, certain sectors come into disfavor at the commission. And I think that and at times certain sectors are relieved from that being in the crosshairs, and that certainly seems to be the case now. But taking a step back at generally speaking how the Trump administration has acted across a variety of agencies, they have certainly, as in prior administrations, pursued enforcement cases against big, juicy targets. And those big, juicy targets tend to be corporations. And I expect that will continue to be the case with the SEC. I think a lot of the comments that we've heard both on this panel and prior panels do suggest that there's going to be maybe a heightened sensitivity to the effect that enforcement actions have on shareholders. But I don't think I would characterize anything about the SEC as pro-business, and I think there's an argument to be made that that's probably should not be their mindset.
Right. So recently, DOJ announced that sanctions and basically any company that's trying to evade the impact of sanctions is going to be under scrutiny, right? So that's one area where This is a big risk for public companies in particular, where they could be manipulating their line items to avoid, reporting the true cost of tariffs or sanctions. They could be manipulating the country of origin, right, if they're trying to avoid sanctions. Jose, I wonder from your perspective, from an auditor perspective, do you think these are real risks, and meaning that the auditors can be catching, that they're not really going to manifest for public companies?
Well, so, given the moving target here, it depends sort of how this all evolves. But at the very least, right, for auditors, when they're planning their audit, they're specifically looking at what are the risks, what are the change risks, what's the regulatory environment like, what are those risks, how do they impact the different financial statement accounts. And the reality is, especially if you read the DOJ's recent announcement, that they believe and they're going to investigate customs fraud, right? And increased tariffs impact your margins, right, for revenue. And so so these are, I think, issues that auditors are focused on as they're planning their audits and executing their audits. The question is whether, how those kinds of cases will, or issues around companies that with liquidity issues and, and if they commit fraud, how they'll be found. And I think this is where sort of whistleblowers also come in, because given the DOJ's recent announcements and just the focus on these issues, where you will have insiders thinking, that they can sort of hit the jackpot and bring out some of these issues. But I don't know, Juan, you and I were talking about this. What else do you think?
I agree, but I think the risk to the auditors are a little less than the companies themselves. A lot of the issues related to tariffs are going to focus around disclosure, MD&A disclosure, and is this administration going to be concerned if someone says, well, these tariffs had this tremendously negative impact on my business? Also, if you think even like COVID, are people going to try to blame tariffs for negative results? And that's going to be right for both CorpFin and enforcement to question it. And under this administration, I don't see anyone saying, no, you can't question that. So I think that's where the risk lies. I think same with interest rate risk, right? As interest rates were hit historical lows, some of these capital intensive companies, interest rates have skyrocketed. So if you have to refinance every 5 or 6 years and you're coming up on that, is that going to have a negative impact or create a liquidity event for your company, right? So you got to start thinking about, do I need to make potential disclosure? Is this going to be material? And it goes back to, how's the SEC going to think about materiality, especially under these circumstances?
What do you think about risk factor disclosures? Everyone knows tariffs are a risk, sanctions are a risk. Mm-hmm. What is good enough for your risk factor disclosure?
From a risk factor perspective, there are those generic risk factor disclosures. But again, it goes back to, if you make a risk factor disclosure and something did happen, you have to say it happened. And that there've been several cases around that, right? So I think that's going to continue. And again, it depends. I would make sure that if you're making any disclosures around tariffs, that you can support it. So if somebody comes calling and says, well, is this really because of tariffs? You have it very well documented.
I think the other thing, right, the cyber sort of framework helps you think about it a little bit. The question is, how will the administration react to it? But in terms of, if you're a company that depends on your supply chain coming from countries that have high tariffs, then part of your risk disclosure should reflect that, so that they can distinguish you from your competitors that maybe don't rely as much on those supply chains. And similarly, if your manufacturing process also brings in imports and processes that are in those countries that have higher tariffs, then that creates that risk, the other risk of potential fraud, that you're changing the country of origin. And so I think a lot of those issues are important, and I think they can impact disclosure depending on kind of where the tariff landscape, sort of where it lands, and how much of an impact this industry or this business or this company has.
And is it going to be a supply chain issue? That's also, you got to think about that and how that's going to impact your business.
Craig, I'll give you the last word. What's your take on tariffs? How should a public company manage these risks?
Well, in my remaining
you got
19
18
seconds, Very careful. Very
Make
careful.
it quick.
Just say Juan and Jose are right. That's all you needed to say.
Yeah, Juan and Jose have got
There
this
you go.
covered.
Yeah.
Wow, great advice. Okay, thanks everyone.